Good afternoon, guys. I wanted to kind of go over the bigger picture and try to get out of the technical side for a minute. And we're going to go over like based off history of bull markets and how long they normally last. Historically, a bull market, this is length and magnitude. They typically last anywhere from 2.5 to 5 years. And we started this in April. I think that puts us at 7 or 8 months right now, and it's a lot longer than bear markets. And the 1990s and the dot com boom at 9.5 years, over a 415% return. Post World War II, 7.5 years, over 253% return. And post GFC from 2009 to 2020, we had 11 years, 400% return. So the bigger picture, I don't think this changes. I think this is kind of how the market works. It pays people that are invested and keep the long term outlook. And just with the dollar dynamic and how the dollar typically goes down from government spending and waste and all that, and the printing of money. And I think that'll continue, especially with the Fed cutting rates and them coming in and buying bonds. I think next year this is going to be they're going to be buying more than 40 billion at a time, and I think they'll start buying the longer dated yields, which will put pressure on the 10 year to bring the interest rates down, and in turn, this will bring prices up, kind of like how I talked about TLT being attractive on the long term, because as the rates, the mortgage rates and stuff get lower, which is your mortgage rate and your car loan, the prices on those bonds normally go up. They both work inversely with each other. All right, the Schiller Cave. Okay, a lot of people are talking about this. We're currently at 39.9. I think the dot com, we were at 44. And this is something to keep an eye on. But I think the only thing that's going to change this story right here and cause the market to really have a crash is if the earnings is not there, which right now all the big tech companies are their earnings are doing really well. Their margins are really high. And back in the dot com bubble, you had companies that didn't have real earnings. So I think the companies and stuff are in good shape. Obviously, it's going to be a big thing that you pick the right company and that you're betting on the right company. That's why if you do the ETF like QQQ or SPY, you take that risk out of it. Okay, Nvidia. I think Nvidia compared to the other stocks is still kind of it's like not undervalued, but it seems to be a decent deal. And this is just the returns that Nvidia is seeing. It's a massive company. I don't have the margins on here, but the margins are really high. Uh, Tesla and robotics. I'm seeing it on my phone now, where you can get a humanoid robot for 50,000, and I believe this is coming very soon in the U.S. Will be the next thing. And Tesla even said that he's gonna, or Elon even said that robots will be everywhere, and he's gonna try to get it at 20,000. So I think this will be the next big push, and Nvidia will be a main component of that. Okay, Fed cuts and the market dynamics and historical patterns. Rate cuts,